Is, I think, one of the most significant shifts in digital infrastructure. And we've all seen it. We're going to be talking about data center investments and how the different models work between real estate and infrastructure. And there seems to be a shift towards infrastructure these days. And this is less of just like a classification. This has to do with how these assets are financed, how they're valued, how capital is structured, and what kinds of returns and risks are being assessed in these types of investments. So clearly real estate is very different than infrastructure, but data centers is where they kind of coalesce. My name is Shant. Yeremian. I'm a partner with PwC. I run an M&A practice that focuses on technology and digital infrastructure. We focus on value creation within this space, and the focus on digital infrastructure is clearly a very relevant one now, from artificial intelligence, data structures, and digital infrastructure. I have a very exceptional panel, I would say, with us today, with very divergent views on this topic. And maybe Ben, we'll start with you and go down the line and introduce yourselves.
Thanks, Shant, and good afternoon, everyone. My name is Ben Forster. I'm a portfolio manager at Schroders. We're a global active asset manager with over 750 billion of assets under management. We invest across the public, private, and wealth divisions of our firm. I personally focus on investing in the publicly listed equity of real estate and digital infrastructure companies. I manage our digital infrastructure strategy, which invests in data centers, towers, and fiber companies. And I would say that data centers is one of our highest conviction strategies across the desk at the moment.
Good afternoon, everybody. My name is Daryl Seaton. I'm CFO at Virtus Data Centers. So we're a data center operator. We've got about a portfolio of about 200 megawatts of live billing and about 600 within the wider portfolio. We operate in the UK, and we're building out data center campuses in Berlin and Milan currently. So a bit of a different lens to Ben. Thank you for joining, and look forward to conversation. Thanks.
So Alexander Oyaert, I'm the CIO at Data4. Before that, I was an infrastructure and real estate investor at Brookfield, so probably why they invited both of us to sit here. But on Data4, so also data center developer and operator. We have a 1.5 gigawatt land bank across Europe. We're present across 6 markets, predominantly in Paris, Frankfurt, Milan, and Madrid. And within the business, I'm basically helping with sources and uses of capital.
Good afternoon. My name is Andrei Milekhin. I head up the digital infrastructure practice for Nomura, globally, in fact. Nomura is a Japanese investment bank. We focus on advisory projects in Europe and globally. In Europe, we're one of the leading advisors in the broader digital infrastructure space and data center specifically, having been involved in a range of transactions, including companies like Data4, for example, as well as a few others.
Good afternoon. My name is Timo Buijs. I'm a senior director at ABN AMRO. I have been in digital infrastructure for over 10 years. One of the leads within the team, and a large focus on data centers, and we finance across the full stack, retail, wholesale, colo, but also, of course, hyperscale and HPC.
Great, thank you all. So we structured this in 4 segments. We have a few topics to talk about. What I'd like to start with is the valuation implications between real estate and infrastructure as we look at data centers. So as some examples, 2 years ago, Digital Bridge and IFM recapitalized into private portfolio of switch data centers at a reported $11 billion enterprise value. And this was structured not as a REIT, but as an infrastructure-led model, and that was 2 years ago. So this shift allowed them to unlock lower cost of capital, and a longer duration and holding term structure. So we look at last year, Blackstone and CPP acquired AirTrunk, which is a data center operator based in APAC, for $16 billion. AirTrunk, as it turns out, was founded only in 2016 as a hyperscaler. And Macquarie, just 4 years ago, invested for an enterprise value of $2 billion. So from 2 billion to 16 in 4 years. These valuations they're clearly increasing very rapidly. And part of that may be because of this shift to an infrastructure model as opposed to real estate. So it begs many questions around this transition and around the valuation models, the risk assessment, and the investment strategy. So Ben, maybe we'll start with you. How are institutional investors like Schroders pricing in infrastructure-like characteristics? So things like, tenure, utility, even ESG performance. How are you thinking about it?
Thanks, Shant. Yeah, that switch example you just gave is a great one, actually, because we were invested in the public equity of the company at the time. So we did very well for our investors through the crystallization of the premium they offered. But I think it was a stage of sort of life cycle thing that really drove the transaction. So as these companies were getting larger and needing bigger commitments for sort of fueling this hyperscale development wave we've just been through, the public market at that stage wasn't really mature enough to sort of give them the time to go through the J-curve and invest in those projects. I would say that the actual classification, to answer your question of sort of real estate or infrastructure and where it is in that spectrum, doesn't necessarily matter to our clients. I think what matters to them is that we invest in the markets which they see sort of opportunities to fulfill their objectives. So across Schroders, we have sort of invested more heavily on a thematic basis over the last 10 years. There's probably 8 or 9 different teams across the firm working separately on data centers and AI as an opportunity. But we all collaborate together to sort of share best ideas and intelligence. But of course, everyone has a slightly different return threshold and risk parameter. It will change across the life cycle of these companies, how mature they are from sort of early stage private equity through to public equity and public bonds. We have private credit and asset-backed lenders as well. So I think it's sort of maturing as an industry to the point now where you can be more specific about the risk and return criteria that you're looking for.
Yeah, makes sense. And we're going to be talking about the evolution in a little bit as well. Daryl, what impact does this have on your financing strategy? So particularly on the capital stack or any of the performance measures or KPIs you're looking at?
I think that there's a big overlap with this section and what you just touched on in terms of the maturity of the sector, but maybe I'll just touch on that for a second. The journey that we've been on in Virtus, and I've been doing this for a while, started off with a kind of outsourcing story where we were saying, data centers, really good place to put your servers, and maybe you don't have the cleaner turn off the plug at the wrong time, and it's a bespoke facility, and people didn't really know how to fund it. So people were looking at it from a real estate perspective sometimes, and that's about location, and it wasn't really a term that people understood. It wasn't a sector that people really had heard of it, but they didn't really know what it was. I think now it's so prevalent in our lives, of course, and the national infrastructure champions are happy to talk about data centers all day long, but it's the same product that's got more used and is in our everyday life. What happens then is the pool of capital, like Ben was saying, that suddenly is drawn to the sector, is drawn to the annuity revenue and the predictability, and suddenly at the same time the amount of capital ballooned that you need for any individual data center platform and across the country and all the geographies that we and our parent company operate in. So you've got a lot of attention on this sector that changed from people who used to say, oh wow, that's a bit different in your private equity portfolio, to why haven't you got a data center platform? Where's your digital infrastructure play? And so for us as operators, that depth of capital is fantastic. It changes everything. I don't think it should change the valuation, but I think it unquestionably does, because more people are interested in those assets. If you've got the right product in the right location and you've got the right track record and story, depending on where you are in your business, there's a lot of capital out there. And that unquestionably means the market becomes a little bit bifurcated. The companies that have a strong record, strong momentum, tend to get very highly valued. The hyperscale bubble, we can talk about that, I'm sure we'll come on to it, is suddenly very, very attractive. And if you've got that revenue from those operators, everyone wants to fund what you've got. If you haven't, it can be a little bit difficult.
And Daryl, like you said, it's a little bit like these assets have grown into the characteristics of infrastructure-like assets, utility even like assets. So it's a bit that the investors have come into this space because the data center market and data centers as an asset class has kind of grown into these investment characteristics as well.
At the same time as our economy's changed, the inflation environment around us has changed since maybe 2-3 years ago. And of course, exactly what you're saying, the wider world loves the attributes of the sector. We always look at it as, depending on what stage of maturity you're at, you've got operational risk, you've got sales risk, and you've got construction risk. I don't think you ever get rid of operating risk, whether people understand that to the same degree or not. But depending on what level of pre-let or what kind of life stage you're at, you can de-risk a funder from a construction and a sales perspective.
But I think what we've observed over the past few years is a shift that has happened where a lot of the businesses in the data center space used to be publicly listed. And now you look at the publicly listed universe of data center players, it's somewhat limited. I think it's a function of explosive growth in the space, capital intensity that these businesses require. And from investor standpoint, I think these businesses are better off being in private hands for a period of time while they undergo this transformational shift in size, right? And the growth that lies ahead. I think, understanding that some projects take years to materialize while you continue to invest capital in them, it's not an easy proposition for public markets. I think so that shift has occurred already, but I think going forward we will see the return of data center businesses to the public markets once they undergo this transformation and emerge as, again, materially larger cash generative businesses with attractive sort of cash flow generation and dividend generation characteristics.
That's exactly right. Yeah. And Alexander, I know we were just talking about your move to Data4. So how has this shifted or informed your investment strategy or your investment planning, either before or now with Data4?
So I think I think maybe before we go there, I would like to touch on an aspect because I think it illustrates the way that my viewing has changed. Is that I do think data centers are essential infrastructure, and case in point is what happened in Madrid, I think 2 to 3 weeks ago, where the entire grid went down, and data centers were one of the only assets still standing due to the backup generators. And there, as a result of that, together with the backup generators around towers and fiber assets, the communication stayed up in a country, and so which was, I think, invaluable for a variety of reasons. And just because of that, I think the way that we look at our investment decisions is not just, okay, are we going to buy this asset or develop this? No, it's also how are we going to operate it? Because I think what this event showed is the value of best-in-class operations. So what we are doing, what we were already doing, but what we're going to accelerate now is partly or more in-source operations, as to make sure that you have sufficient information and knowledge in-house. And that is our conviction in the long-term result in a higher platform value for the company. And that, I think, also illustrates the big difference between real estate and infrastructure, where in infrastructure, not only are the return metrics that you look at different, but also the variables that you take into account to get to certain return targets and how you will make your risk return allocation. And that, I think, from a day-to-day point of view, will also influence the type of investments we make. For a very long time, we have been investing in data center campuses, and we have made the question to ourselves is, okay, should we just invest in assets like other operators? And I think what more and more we realize, especially given the shift from real estate valuation to infrastructure valuation is happening, is that there is so much value in a campus. You create an entire ecosystem which is continuously improving, continuously cash flow enhancing, which helps a lot with raising financing as well, because you're able to do it more on platform levels rather than just on a stabilized asset with a certain metric day one. So from that point of view, I think for operators like Virtus and ourselves, infrastructure investors are basically optimizing the valuation of the business.
Yeah, makes sense. And on that point, I think if we move on to the next topic, which is around integrated infrastructure financing, I think it's exactly what you're talking about. Around it's a different perspective of how you look at investment. So we're seeing a wave of these bundled infrastructure models. So a few examples: Allied Data Centers collaboration with Dominion Energy and AES. For integrated power and land development, and most notably Blackstone's approach with QTS, which combine data, fiber, and power. So this presents, some interesting opportunities and risks and challenges around the financing of data centers within the broader ecosystem. Timo, from your perspective, from the bank side, what's the appetite for multi-asset financing? And in particular, what are the risks and synergies you look at?
Yeah, thank you. I think so ABN has always approached data center financing from an infrastructure perspective. We do sort of combine the knowledge with the real estate and technology teams as well. But I think at the moment you can really see the benefit from approaching it from an infrastructure perspective. Last year we underwrote a large campus financing including a gas-fired power plant. And at the moment we see a lot of opportunities from a financing but also from advisory perspective in bringing together a lot of our energy transition clients and connecting them to data center operators and investors. In the end, power in the end is the bottleneck, and we can help that and solve that. And that is a big benefit approaching this from an infrastructure perspective.
Yeah.
Especially if you have a 15-year lease, on the underlying lease with a AAA credit.
Yeah, that really helps.
Just a bit.
But I also need to say, looking at those processes, it becomes a bit more complex if you include a power plant into a data center financing. It requires additional due diligence. You're not only financing data centers, but also power generation, and that means additional environmental due diligence. So the question is, of course, how far can you go? But at least when you have bankers or lenders that have infrastructure knowledge, I'm pretty sure you can include solar parks, wind parks, substations, power plants, preferably as renewable as possible, of course, but gas power plants are also needed to at least bridge it.
Yeah. It does increase the complexity, as you said, particularly on the regulatory environment and depending on the location as well. So it's an interesting topic. Andrei, I guess similarly from your perspective, what kind of trends are you seeing to deal with this in deal structures?
Frankly,
for
we have
integrated
not
plays?
seen too many examples of this in Europe so far. What we do see, however, is a wave of situations where people who do have access to power are trying to figure out the best way to monetize that access to power. And on that front, we were part of quite an interesting transaction last year in Germany, in Frankfurt, where we advised BlackRock as they acquired a controlling stake in Minova Webhouse from Minova, which took a bit of a gamble. Minova is basically a leading utility in the city of Frankfurt, and they decided that they have access to power, they have access to land. They hired a management team, gave them a few dozen millions of euros to play with, and they managed to secure a contract with tier 1 hyperscaler and started building. And over a period of a couple of years, they accumulated a portfolio of projects with access to power and land. And basically, they ran a process to find a partner to help them develop this business further. And BlackRock sort of came in with quite an interesting and de-risked structure. And I think it's a win-win for both entities, given Minova gets recognition for the value that they've created. They get a super strong partner in BlackRock to take this business further. And I think it's a good example of how a player with energy and power capabilities basically can monetize those. But equally, not every situation like that is successful. There are plenty of players in Spain, for that matter, that are trying to monetize that, and location matters. Unfortunately, for some of them, they're just not in the right place, and monetizing that for the benefit of data center market and data center players is just not going to be easy.
Yeah. And Daryl, from your perspective, how are you seeing this play out from an operator's perspective?
Look, I think I agree entirely with what Andrei said. You got to get this, magical alignment of interests right. So we've been approached by people who want the heat that a data center generates, and could you put it into district heating to heat our swimming pool? Yes. Where's your swimming pool? A long way away. No. could you have incoming power and take from our bio plant? Yes. Of course, where's your bio plant? A long way away. So it doesn't work when the stars aren't aligned. When the stars do align, I think you've got to have the same investor. And if you're trying to mix investors, it becomes really tricky. So, for example, in Wustermark, we chose to locate our Berlin campus near a massive source of renewable energy. That works where on the way in, we decided to buy the plot next to where the power generation was. That's a really strong story. There's no complicated misalignment there. Retrofitting, we've tried in the UK to get a private wire to work, and the agendas are just different. And it sounds good on paper, it should work, but the commitment and who commits to who, in which order, when, and there's too many people involved, it can be tricky, which, like a lot of these things we were talking outside earlier about SMRs. SMRs should work, but everybody's waiting for someone else to kind of make the commitment. It's really expensive, and without someone to hold it all together, it becomes very difficult.
Yeah. So it's a bit opportunistic at the moment for yourselves in terms of combining.
I think combining is tricky. And the other thing, stating the obvious, is never mind SMRs for a second, because that's obviously super expensive. But a lot of the power generation plants is a different expertise to have under one house, right. So have under one roof, to what we do. We're kind of subject matter experts. We're designing, building, operating data centers, not power plants. Yeah. And the person who's backing it, whichever way I look, to my left or right, they want to be backing subject matter experts. Once you've split that, it loses its appeal. Yeah. So I think it works on paper. It should work in practice. We've managed to do it on the way in, where we've chosen to locate a site next to a power generation. But it's not as easy as it sounds. Yeah,
it sounds like it. Ben, I know that you come from it from a different perspective, but from a, I guess, public to private difference. So you're seeing a shift towards real estate investments from an institutional perspective, or the other way around? So does the move towards a private investment limit competition in public markets?
That's a good question. I think in the last few years, as has been noted, we have seen some of these public vehicles going private to give them the opportunity to sort of really gain critical mass and scale up. And obviously in the public market, we like the kind of predictable infrastructure like earnings growth so that the companies can pay predictable dividends out. I would say that the trade-off is when you're in the public markets, you do have total sort of pricing transparency that comes with volatility, and you've seen over the last few months obviously that market sentiment can shift really quickly. So there is a trade-off to be had if you're an operator, whether you want to be focused on sort of high growth, low cash flow sort of stages of life, or you want to come to the public market and be totally transparent. But I think the collective pool of investors that our firm employs are still very enthusiastic about both ends of the spectrum. Really, the data center theme is so strong. We just have to recognise there's times when you want to be in the sort of the more volatile, sort of more liquid and stable, I suppose, earnings growth part of the market, or you want to sort of tuck it away in the private portfolio and allow it to develop.
Yeah, that makes
So
sense.
I understood this morning, I heard this morning, 1 to 2 IPOs of data center companies are to be expected. Would you say the same?
I mean, we're totally jumping into the end here where we make predictions. So I felt like I had that one up my sleeve, and then Mark Ganzi stole the show by answering the question with that answer. I think so, and the pendulum clearly swings between the public and private depending on the financing environment, whether interest rates are high or low, how much capital is required. And obviously at the moment the checks are getting bigger and bigger. I think ultimately it ends up in a place where there's a hybrid between the public and the private markets working together. Just to give you an example, public companies like Digital Realty are now launching their own hyperscale funds. Digital received, I think, $1.7 billion of equity commitments for their fund this quarter. Obviously, our friends at Digital Bridge have raised more than $1 billion again this quarter. And meanwhile, Equinix are sort of deploying X-scale developments around the world for their sovereign wealth fund partners. So the public markets are definitely a place where you can sort of find capital, you can diversify your sources, and I do believe you'll get more companies coming to market over the next year than you'll see leaving the public market.
But I think that is just the long-term history of all financial markets have proven that in the long term assets will be financed most efficiently. Whether that's from the equity or that point of view, okay, you have to go through a certain maturity of the industry, but then I think you'll start to see more different type of companies and assets in a certain market. And those will be financed separately, whether they're co-location assets or long-term hyperscale leased assets, development platforms, stable cos. You'll just see different things, and then whether some of them will be valued, to go back to the beginning, on a real estate type of way, and people will issue a CMBS, or some will really be valued on an infrastructure point of view and get a financing based on a DSCR. I think that's just what we'll see going forward, and IPOs, I fully concur a part of it.
Presumably you won't be short of capital though, Alexander, for the next few years.
We'll see.
Financing.
But it does, we touched on it before, but it's this shift in the evolution of data centers and the different stages it goes through, and the different capital requirements they need at each stage. So there's lots of examples of this, but capital requirements change, investment profiles change, investor profiles change, and return expectations change depending on the stage of development. So it'd be good to explore that a little bit. And maybe, Daryl, I'll start with you. How does the risk profile match the somewhat crowded capital coming into this market from your perspective?
It's a great question, and I think it's both sector dependent and company dependent. So as a sector, the maturity and familiarity is evolving fast as the capital deployed has ballooned. If you take the previous comment and you kind of look back 10, 15, maybe 20 years, Telecity was listed in the UK, and it really struggled because it was the only company that was listed in the sector in the UK, and so people who had a UK portfolio mandate, maybe in Ben's world, and they're investing in UK listed equities, they've got no reference point. And it becomes very difficult to do that. Now we're a lot more global and the sector's ballooned, but certainly for Virtus, we're looking to grow our portfolio from 200 megawatts billing to 600 in 5 years and 1,000 a gigawatt shortly thereafter. And so that proportion of stable assets to development assets also needs to stabilize, excuse the pun, for people to see the risk profile that they're happy with. We talk a lot about the deepening pool of capital and the access to capital, but within that, it's still segmented into people who are prepared to take a little bit more risk and people who just don't want to. And those people who just want to take the income stream, that's fine. That's a very deep capital pool. I used to say to people, thanks very much, but my grandma will do this deal. It's not actually the one that we're looking for because we're at an earlier stage. So as our business matures and we're kind of growing into a market that's really, on everybody's fingertips, it becomes easier, but every business needs to get to a point where the marginal speculative development project, and we're developers in our DNA, different companies have solved that, as you said earlier, digital by doing JVs, so their REIT income is kind of largely ring-fenced and protected, and then their JVs doing all the development. In our core, we're DNA developers, so until we get back to the point where the marginal data center, 5-10% of the pool is actually that speculative bit, then the bulk is, that's not where we are at the moment. So we're very much in building out campuses, like you said. We've moved away from single assets, where over time, by accident, we kind of built this portfolio in Slough, and then we created a portfolio in West London where there were 4 data centers next to each other, but we didn't do it all at once. We did it over time, and it became a campus. Now we're, exactly like you said, building big campuses. When that's got back into kilter, I think we'll be in a different place from a funding perspective.
But obviously, some investors are taking a different approach, where they basically continue to recycle capital and sort of launch the yieldcos, and that's what we see happening more and more. And I think this trend is only going to continue, and if anything, accelerate in the coming years. And I think those assets may potentially be very well suited to public markets because they offer that longevity of contracts and visibility of cash flows and the dividend profile that some public market investors will find quite attractive. And the DevCo will continue to stay in the private hands and continue to develop campuses, etc. So there are, it's not one size fits all in this situation, and we see different investors taking different routes here.
But I agree completely with what you're saying, particularly at scale. If you put 300 data centers into a portfolio and some expire and some don't renew, you've got a very different mix from a CMBS perspective. It doesn't have to be one operator, it could be a lot.
Yep.
But it's different.
And so, Andrei, it raises an interesting question around how you advise around recapitalization, reinvestment, or some monetization event. Depending on, clearly depending on where the entry and exit points are for institutional investors or other private equity investors in this asset. Do you have a view on that? Is there a secret sauce to that, or it depends answer?
Of course, I'll share all the secrets now. But in reality, I think it depends on the pipeline of projects that an investor would have in a DevCo.
Right.
Maybe, so if you have an asset in a single market and you've got an incremental portfolio of smaller projects, and then it doesn't make sense to do the yieldco because there's no place for you to reinvest your proceeds from the yieldco transaction into, right? And therefore, you are then basically doing a platform type transaction for this asset, and it's a stable, sort of relatively stable portfolio with a bit of growth on top, but it's more the scenario that Daryl was talking about, right? On the contrary, you can have a massive platform in a number of markets with huge pipeline of projects, and there is continued potential to create value through those development projects. And in that case, of course, you can try and explore the opportunity to recycle capital by basically offloading the stabilized portfolios of assets that you've got. I think that's sort of in very simple terms how we think about it.
But I think that will also be the very interesting scenario when an IPO happens. What will be placed? What will in the public vehicle? What will be kept private? Will there be a mix, or will it just be one? I think that's really the question that everybody's trying to solve.
Yeah,
because
and the
if you look at
proportions of the long-term, expectations for what's not IPO.
correct, and I think that today, or at least let's say 12 months ago when we were looking into this, what we noticed was that private capital just had a much more interesting cost of capital.
Interesting. Yeah.
What I understood a lot from investors also, that they want to see some upside in some of these vehicles. So not only a stabilized return with some downside risk, but also some opportunity to make some more money.
There's definitely appetite for different types of assets. Again, we could compare and contrast fully stabilized portfolios of assets and pricing for those. It's probably tighter from the cap rate perspective for assets without much development potential. And then sort of next to it you have portfolios with a bit of growth on top of fully stabilized cash flows. And it's slightly wider from the cap rate perspective, but it also allows investors to capture incremental return. And I think that makes it interesting. And I think overall, from our perspective, it expands the pool of capital that can target those kind of deals.
Yeah. And so on that, actually on the debt side, Timo, are you seeing different debt structures according to the life cycle and the stages of development of data centers, and particularly are these evolving over time, over the past 3-4 years, let's say?
Yeah, so it has been discussed quite a lot already today, but we have seen ABS coming to Europe, of course. And I think looking to the next 2 to 3 years, and I hope I'm not already doing some predictions, but we definitely believe that we also support alternative pockets of capital. ABS, we will see a couple of them this year, but I think also private placements, so larger rated or unrated debt transactions will definitely come to Europe. We had multiple discussions with rating agencies. They are developing their rating strategies on data centers, and it will only become more interesting once they actually see it happening here in Europe as well.
Makes sense. I want to move on to our last topic, and this is around the long-term economic or market implications of this shift. So, over time, but particularly over the last 12 months, we've seen a lot of pension money coming into this space, a lot of sovereign wealth money, infrastructure platforms, outperforming REITs in particular, for hyperscale assets at least. GIC and MEAG, which is the asset management group of Munich Re, they invested into Vantage data centers for $1 billion. And so this is changing who plays in the market, how they play in the market, and of course there's lots of money coming into this space, but institutional investors obviously and pension funds take a very longer term view than most private equity. So again, how does this change financing models and reshape the dynamics of this sector? Ben, maybe I'll go back to you. How are you seeing more infrastructure funds crowding into, or outcrowding the traditional REITs from a public markets perspective?
I think it goes back to the point about over the last 5 years, we have seen these big platforms taking private some of the kind of mid-cap stocks in our world. But I think, as I mentioned, the pendulum's kind of swinging back now, and we're seeing the sovereigns wanting to partner with the platforms which are still in the public space, because ultimately they still have the leading scale and access to capital, the best brands, arguably. So we're sort of moving towards this, I think, market where you have different offerings for different types of investors. The public markets is still a great place to be from that perspective. And actually, if you look across Asia, there has been a proliferation of opportunities kind of emerging, other companies which don't hit the radar as often. So, yeah, I think the infrastructure investors can also invest through the public markets. It's not just in these large private platforms.
Yeah. And Timo, what about you? What type of structures or counterparty types in particular are emerging out of this ecosystem?
Lease counterparties, you mean?
Yeah.
Yeah, it's a good question. So the typical enterprise colo business we all know, hyperscale is well known. Now we see a lot of movement in the Nordics with HPC and GPU as a service providers. It's bringing us in some new territories, but I also need to say I like it. It gives me some additional work, some good credit analysis again. So we will see this more often because these companies are there and they will also grow and they will need a lot of data center capacity as well. We will see European AI investors. I think we haven't seen of European AI companies, we haven't seen them that much, but given the latest support in Europe, the 20 billion investment scheme, we definitely believe and would also really like to support such kind of projects where we can stimulate AI factories in Europe. And then the third one is, I think, Asian cloud parties that will definitely would be interesting in expanding in Europe, storing their data in Europe, and that's also something that we are actively exploring.
And are you not seeing the AI parties from Europe? Is that because they're being outperformed by the US players?
Well, what I mean is at the moment they're still relatively small. With the new investments, they will look at larger data centers, which means that those data centers could be standalone financed, hopefully, or in a portfolio form, but they will be more noticeable, whereas in the past it was only a small part of the sort of client portfolio.
Right. And Alexander, what kind of strategies do you deploy in this market for long-term investment? So particularly like joint ventures, and how do you approach that for long-term returns?
So I think for us it goes back to okay, what type of income or cost streams do you have, and then what is the right type of capital? Right. So given that, to Daryl's point earlier, like we've seen our portfolio evolve, and so now we have a relatively big part of the portfolio which is income generating, has like a 9-year WALT, and is very stable. When we discuss that with our shareholder, they're like, that is not necessarily, where we want to invest our money. And so is there other capital out there? And so that's the process that we're currently doing. So we are selling majority stakes in stabilized assets. And what we found there is that there is a big pool of capital out there that is not necessarily educated on the space, but that's very keen and willing to learn and to invest. And so what we've gone through is a big education process to basically find like the right type of long-term capital partner. This is what we found our partners who want to invest on 10, 15, 20-year basis, which basically matches the asset cash flows that we have contracted. And so that, I think, to Andrei's point as well earlier, like this is something we'll see more going forward.
Interesting. I'm going to throw an off-piste question out here to any of you who want to answer. From my perspective, I'll take the chance. From a value creation perspective, my practice looks at value creation a lot, and value creation, on the entry of an investment, value creation through the holding period of an investment, and on exit. So this can take many forms in data center assets. We can think about it in terms of increasing tenancy, which is not really a problem these days, lowering operating costs, in the context of a very dynamic and changing technology market that's feeding the GPUs and the servers and the actual technology that goes into these data centers. So again, just an open question, but how do you view creating alpha in this market? Creating value from either as an operator to your shareholders, or as an investor, or as an advisor? How do you view value creation within data centers either as an infrastructure asset or a real estate asset?
Great. Take a quick stab from our perspective, because as unashamed active managers, creating alpha is exactly what we're expected to do for our clients. Now, clearly, the volatility we've seen over the last few months with the trade tariffs coming and then going in quite quickly has presented some opportunities to invest at very different prices to what we expected coming into this year. So I think really it just reminds us that in a very uncertain world, if you invest through the public markets, you have the opportunity to diversify your portfolio risks. You can invest in data centers, towers, fiber, if you like the digital infrastructure sector. And there's times when different parts of the portfolio will outperform. And then within those buckets, of course, certain companies are better positioned to weather the storm if we move into a more recessionary period. So from our perspective, it means building a portfolio of stocks that complement each other, and picking them at the right prices, hopefully.
So from your perspective, portfolio structuring clearly, and entry point, I think I heard.
Absolutely.
Yeah.
I think as a developer and operator, you're faced with constraining factors. And I think you create alpha by just exploiting those and taking positions ahead of time. And in data center, I think you have three key ones, which is power, land, and talent. And so if you anticipate on those, like, for example, Virtus did in Wustromar, that will pay off in the medium to long term.
Makes sense. I know we've got 2 minutes, 1 minute, 2 minutes. Any questions from the audience? Yep.
What do you say is the scope for potential securitization of data center debt assets? So allow existing tenants to diversify their portfolios and get into new assets?
And sorry, what do you mean with scope?
Securitization of data center debt portfolios.
I think it's definitely one of the key diversification options for any European operator.
I would say this year we will see about 2 or 3, and next year I think it's only going to increase. Once, of course, they prove to be successful and the rates develop in a good way, it can only improve, I think.
And I suppose, just in answer or exploring that question a little bit, the shift that's going on and the changing dynamics between hyperscalers and AI data centers and storage data centers, I mean, it creates some volatility in the expected longevity of any one and how that's going to shift, right? So securitization is great when you've got a very stable stream of coupons coming in, basically. And it seems like it's not so certain in any one market just yet because of all the dynamics in the industry.
I think maybe final comment from me. This is a complicated sector, and we dismiss that at our peril. It's hard to get power. It's hard to build on time for customer requirements. Customers are not that easy. They never were, and they're certainly not right now. So if you can take the risk to actually put yourself in a position where you sprinkle your magic dust to solve those problems and take a raw product into that finished product that enables somebody, in that sense, to clip a coupon, you've done your development and value add at some point along those journey. And as developers, that's what we're here to do. Now, patient capital is what you need. You need to find the right capital for your stage, but the gestation period of the campuses that we're building out now, depending on the velocity at which you can sell them, has extended. There's a slight mismatch in the market at the moment between that 20-year capital and the aversion to risk, because the 20-year capital wants the income to match a corresponding pension liability. They can't have risk at that moment. So there's a good gap to be filled by debt providers and capital allocators along that journey. As we as a sector and we as a geography get more mature, you'll see more of those securitizations because the capital has to come from somewhere and has to go somewhere to be recycled.
Great. I'm being threatened with ritual torture if I don't stop. So I want to thank the panelists for an excellent discussion. Thank you very much.
Thanks, everyone.